I think that 97 area was a pivotal area for a lot of people. In fact, not only was it pivotal for the Forex community, it was also very pivotal for the hedge fund community. And I think it's going to continue for the rest of the year, Wilfred. Remember, you've got all this repatriation going on. And we've been saying it now for the last few months. Whenever you have $1.5 trillion being repatriated, this puts upward swap pressure on dollar swaps. So that's exactly what's been happening. Now, you couple that with the fact that November 15th is Armageddon Day for hedge funds. Remember, it takes 45 days where you have to have your orders in to actually have redemptions, and you're facing tens of billions of dollars in redemptions. So you've got a hedge fund community right now that is panicking, and a lot of the selling that has been taking place has actually been liquidating these portfolios and getting ready for what they perceive to be a tidal wave of redemptions on Thursday.
Keith, I mean, there's a lot of factors right now. Dollar's just one of them. Obviously, those China trade tensions that Eamon mentioned. Apple's got some specific, Goldman's got some specific issues. What do you think is unnerving investors the most today?
Well, I really think it gets back to a global growth story. The Apple news and what's happening with momentum feathers right into that narrative quite nicely. A little bit of the sell-off in oil has that with an oversupply. Nobody's absorbing the oil and using it. You're seeing a very defensive trade today, even though we have a bit of a low volume day with the Veterans Day holiday being celebrated today. But you're seeing rotation into utilities and consumer staples. Financials and tech and consumer discretionary are the three weakest performing sectors right now. So you're seeing a little bit of that defensive posture. What Jack says is absolutely accurate. People are starting to liquidate some of their positions around there in anticipation of redemptions. But I think the broader weakness, you've got a storm of things coming at the market right now that is really playing into the trade this week.
Should point out, we're just at session lows. That's down 556 points at the low, which is, we're down 550 at the moment. Over 2% for the Dow, 2.8% for the NASDAQ. S&P's down 1.8%. Peter, you actually reversed your own bullish S&P 500 call last week. Why did you reverse it last week? And have we pulled back enough on days like today for you to start to turn positive again?
Right, well, we're very careful to sort of differentiate between tactics and strategy. I was tactically bullish, after the mid-October low. I felt there'd be a performance chase to some extent into the end of the year. And of course, depending how much the market ran, we would decide at that point in time whether we would reverse that call or not. I felt that 2,800 had really run its course. There might be a bit more of a chase into the end of the year, but I think it's pretty much done. More strategically, all the things that Sarah alluded to earlier are correct. We moved very quickly from a synchronized global growth narrative from a synchronized global growth narrative into one of a synchronized global slowdown. We're starting to see peak earnings growth. Monetary policy globally is much tighter than it was a year ago. And rates in the U.S. are quite a bit higher, especially on the short end. And into the end of the year, I think we could see LIBOR at 280. And this affects funding costs for companies. It has a real impact on earnings.
Tighter financial conditions, Keith, not the prospect of presidential harassment by the Dems causing the stock market headaches. Is that playing into this at all?
Yeah, I don't think so right now. Even when the Republicans had both houses of Congress and the presidency and kind of controlled things, the Dems were still taking a lot of shots at that. And let's face it, the president had a lot of things that he had to hit back across the net. Didn't really impact the market all that much, as we've seen it, run straight up. There is the prospect that things could get a little bit thornier for him, and I think we all recognize that it will be, but I don't think that's going to cause massive panic and sell-off. Remember, the stock market is really based on the valuation, the future valuation of the discounted cash flows of the companies underneath it. And it's really about the economic situation around the globe that's going to dictate those prices.